On Black Thursday, the market collapsed. $30 billion vanished in a single day. Men who had been wealthy that morning were not wealthy that evening. The most celebrated financial minds in America stood on the floor of the New York Stock Exchange, watching their fortunes dissolve in real time. One man was not on the floor: Bernard Baruch. Bernard Baruch had been selling since 1927, not panicking, not reacting. Selling, deliberately, systematically, 2 years before the crash, while the rest of Wall Street was still buying. By the time Black Thursday arrived, he had already moved. The storm hit everyone else. It did not hit him. That evening, Baruch hosted a farewell dinner for New York's financial elite. The guest of honor was Winston Churchill, the former First Lord of the Admiralty, the future Prime Minister of Great Britain, and at that precise moment, a man who had just lost the equivalent of $1 million in today's money. Churchill had arrived in New York 6 weeks earlier as Baruch's personal guest. He had stayed in a hotel suite Baruch paid for. He had used an office Baruch provided in the Equitable Building. He had traded through brokers Baruch personally recommended. And when the market collapsed, Churchill stood up at that dinner table, raised his glass, and proposed a toast to friends and former millionaires. Baruch was not a former millionaire. He reported income of nearly $2 million for 1929. While Churchill wept and told Baruch his political career was finished, that he would have to go into business to pay his debts, Baruch quietly wrote him a check to cover the losses incurred using his own brokers. Now here is the question the official version of this story never asks. Bernard Baruch did not come from money. He started on Wall Street at $3 a week as an office boy. He had no family dynasty, no inherited position, no established network. J.P. Morgan, the most powerful private financier in American history, called him a card cheat. The financial establishment wanted nothing to do with him. And yet by 1929, this same man had run the entire American war economy as chairman of the War Industries Board. He'd advised Woodrow Wilson at the Paris Peace Conference. He had the private ear of every president from Wilson to Truman. He had accumulated a fortune that survived the crash that destroyed everyone around him. And he had done all of it while deliberately refusing to join any established financial institution, earning him the nickname that Wall Street gave him and that he wore for the rest of his life: the Lone Wolf of Wall Street. Plenty of men were geniuses in 1929 and lost everything anyway. The question is what kind of information a private citizen accumulates when he spends a decade sitting in the rooms where the decisions that move markets are made before those decisions become public. Because the man who sits at the intersection of Wall Street and Washington does not need to predict the future. He simply needs to read his own mail before everyone else reads theirs. This is the documented story of Bernard Baruch. We will examine exactly what he knew, when he knew it, how he built the access that made his positioning possible, and what the primary sources say about a man whose legend has been told so many times that the actual documented record has almost entirely disappeared behind it. The legend says he was a genius who saw the crash coming. The documented record says something more interesting than that, and considerably more instructive. Bernard Manus Baruch was born on the 19th of August, 1870, in Camden, South Carolina. His father, Simon Baruch, was a physician, a German immigrant who had served as a Confederate Army surgeon during the Civil War and who after the war became one of the founders of physical medicine as a medical discipline in America. His mother, Belle Wolfe, came from a family that had been in South Carolina for generations. The family was comfortable but not wealthy. And the world into which Bernard Baruch was born in 1870 was a South still living in the wreckage of Reconstruction, a society where the old certainties had been destroyed and the new ones had not yet been built. When Bernard was 10 years old, the family moved to New York City. The transition was not easy. The Baruch boys were Jewish in a city where that carried specific social costs. Bernard later recalled being taunted and having to fight his way through his early years in New York with a combination of physical courage and competitive determination that would define his entire life. He attended the City College of New York, graduating at the age of 19. He was not a distinguished student. What he was, from the earliest age, was a reader of people and situations with an accuracy that most men never develop regardless of their education. In 1890, he took a job as an office boy in a small New York brokerage house at $3 a week. He had no connections, no inherited position, no introductions to the men who ran Wall Street. What he had was an ability to watch markets the way a hunter watches terrain, reading not the individual movements but the patterns underneath them. Within 7 years, he had worked his way to partner at A. Hausman and Company. And then in 1903, at the age of 33, he did something that defined the rest of his career. He gave up the partnership. He gave up the security. He gave up the institutional backing. And he set up on his own as a private speculator, investing nothing but his own money from his own office at 111 Broadway. This decision was not conventional. In the financial world of the early 20th century, operating outside an established institution was considered either eccentric or suspicious. The great houses, Morgan, Kuhn Loeb, the national banks, were the engines of American finance. A man who refused to attach himself to any of them was either unable to gain entry or foolish enough to think he did not need it. The financial establishment assumed it was the former. They were wrong. Baruch understood something that the institutional men did not. That independence was not a weakness. It was the most valuable asset a financial operator could possess. An institutionally affiliated trader was constrained by the interests of his institution, its clients, its credit lines, its relationships, its reputation. An independent operator owed nothing to anyone. He could move when he chose to move. He could sell when everyone else was buying. He could go against the market without asking permission from a committee. And he could position himself based on his own assessment of reality, rather than on the consensus view that his institution needed to maintain for commercial reasons. J.P. Morgan saw this and called it cheating. What Morgan meant was that Baruch was playing a different game from the one the established houses were playing, and that his rules gave him advantages that the institutional framework was designed to prevent. Morgan was not wrong about what Baruch was doing. He was wrong about what to call it. Baruch was not cheating. He was thinking. In 1901, he made his first major fortune by correctly positioning himself in the American Smelting and Refining Company against the conventional market view. In the years that followed, he accumulated positions in sulfur, rubber, and railroad securities, always moving against the crowd, always selling when others were buying, always reading the terrain underneath the individual movements rather than the movements themselves. By 1910, Bernard Baruch was worth several $million. He had done it entirely alone. No dynasty, no inheritance, no institutional backing, just a ruthlessly independent mind operating with the freedom that his refusal to join any established house had purchased for him. And he had done it in a way that made him genuinely dangerous to the men who ran American finance. Because a man who does not need you cannot be controlled by you, and a man who cannot be controlled is either an enemy or an ally. The financial establishment had tried the first option. Washington was about to try the second. If you have not subscribed to the channel yet, please do it now. This is exactly the kind of financial history we cover, the documented mechanisms behind the events that shape the modern world. Every subscriber genuinely matters to what we are building here. Now hold that picture. A self-made speculator who started at $3 a week, refused every institutional offer, built a fortune entirely on his own terms, and made himself simultaneously the most independent and the most dangerous financial mind of his generation. Because what happened next is the part of the Baruch story that the standard account almost never examines directly. The part that explains not just how he survived the 1929 crash, but why his survival tells us something important about the relationship between financial markets and political power that nobody in 1929 wanted publicly acknowledged. In 1916, Woodrow Wilson appointed Bernard Baruch to the Advisory Commission of the Council of National Defense. It was the beginning of a relationship between Baruch and the American presidency that would last for nearly 50 years and would fundamentally change what it meant to be a private citizen with political access in the United States. Wilson had noticed Baruch during the presidential campaign of 1912 when Baruch had become one of his significant financial supporters. Wilson was a man who understood the difference between men who gave money to political campaigns for social reasons and men who gave money because they understood that political outcomes had financial consequences. Baruch was clearly the second kind. And Wilson, who was surrounded by advisors whose financial sophistication was limited, valued the first kind of mind enormously. When the United States entered the First World War in April of 1917, the government faced a problem that no American institution had ever confronted at that scale. The entire industrial capacity of the country needed to be redirected toward war production simultaneously. Steel, rubber, copper, coal, railroads, shipping. Every sector of the economy needed to be coordinated toward a single military objective without destroying the commercial infrastructure that would be needed when the war ended. The War Department attempted to manage this process and failed. The coordination required was beyond the capacity of any conventional bureaucratic structure. Wilson turned to Baruch. In March of 1918, he appointed him chairman of the War Industries Board. giving him authority over the allocation of raw materials, the prioritization of production contracts, and the coordination of industrial output across the entire American economy. It was the most concentrated economic authority ever given to a single private citizen in American history. Baruch later estimated that the War Industries Board controlled approximately half of all American economic activity during the final year of the war. To understand what this meant in practice, consider what information flows through the hands of the man who decides which industries receive government contracts and which do not. He knows before any market participant which sectors are about to receive enormous injections of government demand. He knows which raw materials are about to become scarce because they are being redirected to military production. He knows which companies are about to become strategically essential and which are about to lose their primary customers. He knows the financial consequences of decisions that have not yet been made public, in some cases decisions that will not be made public for months. Baruch later claimed, and the historical record supports, that he tried to insulate his personal financial positions from his official knowledge by moving his assets into government bonds for the duration of his service. What the record also shows is that the men around him, the industrial executives, the bankers, the commodity traders who populated the War Industries Board and its associated committees, did not all make the same choice. The War Industries Board was, as financial historian James Grant documented, the first American precedent for centralized economic planning. And centralized economic planning, whatever its public justifications, concentrates financial information in the hands of the people who run it in ways that the market cannot replicate. When the war ended in November of 1918, Baruch accompanied Wilson to Paris for the peace conference as a member of the Supreme Economic Council. He was in the room where the reparations terms were being negotiated, the terms that would determine the financial architecture of post-war Europe for the next 2 decades. He argued, publicly and on the record, against punitive reparations for Germany. He believed they would destabilize European finance in ways that would eventually come back to damage American markets. He was correct. But the significance of his position in Paris was not just the correctness of his analysis, it was the access. A private citizen with no elected mandate was sitting at the table where the financial terms of the post-war world were being decided. And when he returned to New York, he returned with a network of relationships, a depth of institutional knowledge, and a quality of information access that no amount of money could have purchased on the open market. This is the context that the legend of Bernard Baruch, as the self-made genius who saw the crash coming consistently omits. He did not see the crash coming through analysis alone. He saw it through the accumulated intelligence of a man who had spent a decade at the intersection of Washington and Wall Street, who understood not just the financial mechanics of the 1920s bull market, but the political decisions that were being made about monetary policy, credit expansion, and regulatory oversight that were inflating it beyond any sustainable level. The question is not whether that access informed his positioning. The question is, how could it not have? This is the kind of documented financial history that the standard account almost never tells you directly. So we now have the complete picture of what Bernard Baruch actually was by the 1920s. Not simply a gifted speculator who happened to position correctly before the crash, but a man who had spent the previous decade running the American war economy, advising the president at the Paris Peace Conference, and building a network of political and financial relationships that gave him access to information about the direction of the American economy that no ordinary market participant could possess. Now we need to examine what he actually did with that access in the years before Black Thursday, and what the documented record shows about the relationship between his political knowledge and his financial positioning. The 1920s were the most extraordinary period of speculative excess in American financial history up to that point. The stock market had been rising continuously since 1921. Credit was cheap. Margin lending had exploded. Ordinary Americans, school teachers, factory workers, shop owners, were opening brokerage accounts and speculating in stocks for the first time in their lives. The market had become a national religion. Irving Fisher, the most respected academic economist in America, declared in October of 1929 that stock prices had reached what looked like a permanently high plateau. Bernard Baruch was not buying the permanently high plateau. He had begun reducing his equity positions in 1927. By 1928, he had sold all his shares and moved primarily into bonds and cash. On the 25th of September 1929, just before Black Thursday, when other investors were being offered the opportunity to participate in 2 new investment trusts called the Shenandoah Corporation and the Blue Ridge Corporation, Baruch declined. His response, which was documented at the time, was characteristically precise. He described the formation of these companies as financial whoopee. The market disagreed, and then the market crashed. He also advised Will Rogers, the most popular public entertainer in America, to sell his stocks before the crash. Rogers did. The advice was not given privately. It was given in the context of a friendship between two public figures. And the fact that Baruch was willing to give it publicly suggests that his conviction about what was coming was not tentative or uncertain. It was the certainty of a man who had read something in the available information that the men around him had either missed or chosen to ignore. What had he read? The documented record points to several specific signals. The Federal Reserve had been expanding credit throughout the 1920s in ways that Baruch, with his War Industries Board experience of the relationship between government monetary decisions and market consequences, understood as structurally unsustainable. The margin debt in the system by 1929 was so large that any significant market decline would trigger a cascade of forced selling that would amplify the initial decline beyond any rational stopping point. The political signals from Washington, the congressional debates about tariff legislation, the Federal Reserve's increasingly uncomfortable relationship with the credit expansion it had enabled were moving in directions that any man with Baruch's access would have read as warning signs months before they became public. This is not to say that Baruch had specific inside information about the timing of the crash in the conspiratorial sense. The crash was not engineered by any single actor. It was the inevitable consequence of a decade of credit expansion and speculative excess meeting a set of specific triggers. The Smoot-Hawley tariff debates the Federal Reserve's late attempt to tighten credit. The structural fragility of an over-leveraged system that no single person could have precisely timed. What Baruch had was something more fundamental than a specific tip. He had a framework for understanding the relationship between political decisions and financial consequences that was built on direct personal experience of running the most powerful economic coordination mechanism in American history. When he read the signals coming out of Washington in 1927 and 1928, he was not reading them as an outsider trying to guess what the government would do. He was reading them as a man who had been inside the decision-making apparatus and understood how those decisions translated into market outcomes. The result was a positioning that looked like genius from the outside and looked like information from the inside. By the time Black Thursday arrived, Baruch had reduced his equity exposure from $22 to $25 million, to a level that allowed him to report income of nearly $2 million for 1929, while the market lost nearly half its value. He did not escape entirely unscathed. His financial assets declined from their peak. But he survived in a condition that made him one of the very few major financial figures of his era to emerge from the crash with his fortune and his reputation substantially intact. Winston Churchill arrived in New York in early October of 1929 as Baruch's personal guest. He was traveling with his son Randolph, his brother Jack, and Jack's son John. The trip had been organized partly around a lecture tour that would supplement Churchill's income. He was a prolific writer and speaker who consistently spent more than he earned and whose financial position was permanently precarious, and partly around Baruch's personal invitation and hospitality. Baruch picked up the hotel tab at the Savoy Plaza. He provided Churchill with an office in the Equitable Building and introduced him to his own network of East Coast brokers. Churchill had been speculating in stocks throughout the American leg of his trip, opening accounts in California, trading through multiple brokers across different time zones, deploying what he described in letters to his wife Clementine as his massive maneuver, the cash reserve he maintained specifically for speculation. By the time he reached New York and began trading through Baruch's brokers, he had already made some profits from earlier positions and was confident enough in his market judgment to increase his exposure significantly. The confidence was not warranted. Churchill was, in the words of his biographer William Manchester, a born losing gambler, a man of extraordinary intelligence and almost no financial discipline who approached the stock market the way he approached military campaigns, with boldness and without sufficient attention to the downside. He had no framework for reading the relationship between political decisions and market movements of the kind that Baruch had spent a decade developing. He was trading on instinct and on the advice of men whose own instincts were about to be catastrophically wrong. On the 24th of October 1929, Black Thursday arrived. The market lost 13% of its value in a single session. Churchill watched it happen from Baruch's office. That evening, at Baruch's farewell dinner for New York's financial elite, Churchill raised his glass and proposed his toast to friends and former millionaires. It was the most English possible response to financial catastrophe, a witticism that communicated the full weight of the disaster while refusing to show distress in public. In private, the distress was real. Churchill's losses of more than $75,000, equivalent to approximately $1 million in today's money, were devastating to a man who was already financially overextended. He came to Baruch in tears and told him his political career was over. He would have to go into business to pay his debts. Baruch felt partially responsible. He had introduced Churchill to the brokers through whom the losses had been incurred. He had provided the office and the infrastructure through which Churchill had deployed his capital into a market that Baruch himself had been quietly exiting for 2 years. He wrote Churchill a check for $7,200 to compensate for the losses incurred specifically through his brokers, and he gently corrected Churchill's assessment of his own situation, telling him that his political career was not finished and that the debt was manageable. The check deserves examination. $7,200 in 1929 is approximately $100,000 in today's money. It is a significant sum to give a friend as compensation for losses in a market where everyone who was still participating was losing money. The gesture communicates something about the nature of the Baruch-Churchill relationship that the official version consistently underplays. This was not simply a friendship between two remarkable men. It was a relationship in which Baruch occupied a position of financial and informational superiority that he exercised with a combination of generosity and strategic calculation that was entirely consistent with everything else. The documented record shows about how he operated. Churchill needed Baruch's money, his contacts, his access, and his political judgment. Baruch needed the relationship with the man who was, whatever his current financial difficulties, one of the most consequential political figures in the English-speaking world. The check was not charity. It was an investment in a relationship that would pay returns for decades. Their friendship continued for the rest of their lives. Baruch was one of the few men in the English-speaking world who supported Churchill's warnings about Hitler in the 1930s when Churchill was in the political wilderness and almost nobody in the British establishment was listening. Their last meeting was in April of 1961, when Churchill arrived in New York aboard the Onassis yacht. They dined together. Baruch accompanied his friend to the airport. Baruch died 6 months after Churchill in June of 1965 at the age of 94. Their friendship, Baruch said, had been a source of inspiration and pleasure that had grown more rewarding with each passing year. What he did not say publicly, and what the documented record makes visible to anyone who reads it carefully, is that it had also been one of the most consequential political-financial relationships of the 20th century, a relationship whose origins lay in a farewell dinner at the end of Black Thursday and a toast to friends and former millionaires. The legend of Bernard Baruch is the story of a self-made genius who saw the crash coming through superior analytical intelligence and positioned himself accordingly. It is a compelling story. It has the structure of an American meritocratic myth. The man who started with nothing and through pure intellectual firepower outfought the most powerful financial establishment in the world. And it is not entirely wrong. Baruch was genuinely brilliant. His analytical framework for reading markets was sophisticated and original. His willingness to act against the consensus view when the evidence supported it took a kind of intellectual courage that most men do not possess. But the documented record shows a story that is more interesting than the legend and more disturbing. Because the thing that separated Baruch from the other brilliant men who lost fortunes in 1929 was not analytical intelligence alone, it was access. Specifically, it was the access that comes from spending a decade at the intersection of Washington and Wall Street in a position of genuine authority, running the War Industries Board, advising presidents, attending the peace conferences where the financial architecture of the post-war world was being determined, and then returning to private life with that accumulated knowledge intact. The Nye Committee in Congress investigated Baruch's role in war profiteering in the 1930s. The investigation found evidence of relationships between the War Industries Board's decisions and the financial positioning of men connected to it that the committee described as troubling. The investigation did not produce criminal charges, but it documented something that the legend of Baruch as the self-made genius consistently obscures, that the boundary between public service and private financial benefit is not always as clear as the official account suggests, and that a man who runs the American war economy is not simply a public servant during the time he holds that position. He is also an accumulator of the most valuable form of financial intelligence that exists, knowledge of what governments are going to do before governments announce it. The dollar has always been managed, markets have always been shaped by political decisions, and the men who understand both systems, who can read the political signals that translate into financial consequences before those signals become public, have always had an advantage that no amount of analytical intelligence alone can replicate. Baruch understood this better than almost anyone of his generation. He built his career on it, and he was honest enough, at least in private, to acknowledge that his positioning before the crash was not simply a product of genius. In his memoir, he described his approach to markets not as prediction, but as reading the information that was available to him, all of it, including the information that his decade in Washington had given him access to in ways that no amount of market analysis could have substituted for. The men who lost fortunes on Black Thursday were not stupid. Many of them were brilliant. What they lacked was not analytical intelligence, but access. They were reading the publicly available information about the American economy in 1929 and concluding, reasonably, that the bull market had further to run. What they could not read was the information flowing through the private channels that connected Washington's monetary policy decisions to the credit architecture of the financial system. The conversations in Federal Reserve meetings, the congressional debates about tariff legislation, the political calculations being made about when and how to tighten the credit expansion that was driving the market's rise. Baruch could read those channels. He had spent a decade inside them. There is a lesson in this that goes beyond the biography of one remarkable man. The lesson is not that the system is rigged in the simple conspiratorial sense. The lesson is that access is a form of capital, the most durable and the most invisible form of capital that exists. It does not appear on any balance sheet. It cannot be inherited in the conventional sense. It cannot be regulated away by any legislation that has ever been passed. And it compounds silently, decade after decade, in ways that the men who benefit from it rarely acknowledge publicly, and the men who lack it rarely understand completely. Bernard Baruch started with nothing. He built something, and what he built was not simply a fortune. It was a position at the intersection of the two most powerful systems in American life that allowed him to read the world with a clarity that the men around him, for all their intelligence and resources, simply could not match. The lone wolf of Wall Street. The man who refused every institutional offer and ended up more powerful than the institutions that rejected him. The man who watched Black Thursday from a position of safety he had been building for 2 years while the future Prime Minister of Great Britain wept in his office and proposed a toast to friends and former millionaires. The documented record is open. The War Industries Board archives are accessible. Baruch's own memoir is in print. The Churchill biographies that document their relationship in detail are on library shelves. This is not legend. It is the paper trail. And it tells a story about the relationship between financial positioning and political access that is considerably more instructive than the version that has been recycling itself for nearly a century. If this is the kind of forensic financial history you have been looking for, please subscribe to the channel. And if this video changed how you think about a man you thought you already understood, share it with someone who still believes the legend. Leave a $sign in the comments if you made it to the end. It seems appropriate. I will see you in the next one.